Thank you for being here with us. I first of all would like to welcome Dr. Shin, the economic advisor and head of research at the BIS, and I wish to express my sincere thanks to him for participating in the 37th edition of the Barcelona Graduate School lecture series. And I would also like to extend a warm welcome to Professor Freixas and to all of you, students and members of the Barcelona Graduate School of Economics, members of the team at Banc Sabadell with us today also, and ladies and gentlemen, this evening here at Banc Sabadell. In a moment, I'll hand you over to Professor Freixas, who will give us some insight on Dr. Shin's distinguished career. But before this thought, I would like to say a few words about the topic of today's lecture, since it's particularly relevant in the current global context. After years of keeping rates close to zero, or even below zero, and substantially increasing its balance sheet, the Fed has managed to raise rates 3 times in the last 18 months. The Fed's first hike in December 2015 led to a substantial and relatively quick appreciation of the US dollar and a tightening of global financial conditions. Coupled with the collapse in the oil price, fears of a new global financial crisis became central to the economic scenario, as both emerging and some advanced economies were severely affected by this context. Subsequent hikes by the Federal Reserve, however, have not had such dire consequences. It's fair to say that the Fed is now in a hiking mode rather than making small adjustment to the official interest rate. In this new phase, Fed hikes are barely affecting the US dollar. Dr. Shin is a key choice in the discussion about the role of the US dollar in the global financial system and the fundamental changes that are taking place in forex markets due to issues such as the increased demand for hedge and or constraints to arbitrage opportunities. Since this topic is of the utmost importance today, it's a privileged opportunity for us to gain insight into the current complexities and challenges of and for the global financial system. Thank you very much again, Dr. Shin, for being here with us, and Professor Freixas, the floor is yours.
Thank you very much. I will be very brief in introducing Hyun Shin, but let me first welcome you. It's a pleasure to have you here, and let me say it's always also a pleasure to be able to introduce you. And what initially I know of Hyun Shin's work was his theoretical side. So we were in a world where we believe Diamond Dybvig was the reasonable paradigm for crisis, and then suddenly we discovered that there was a better way, in the sense that global games and the work of Maurice Shin allowed to understand that it was not just random crises like coordination devices that came from sunspots. It was really related to fundamentals and coordination. And that was a great insight. Since then, his theoretical work has covered a number of issues, but this coordination, these currency attacks and the like were really very insightful and quite helpful in the banking as well as international finance framework. Since then, his theoretical papers on banking have always been path-breaking, and I think always that he has a way to think outside the box that is particularly attractive and provocative. But then I discovered he had also an empirical side. I don't know if the fact that there was a crisis out there helped. But his paper with Adrian, the Adrian Shin discovery, is always cited because it shows what the real behavior of banks is and how their leverage reacts to the increase of the value of their assets. So that somehow it's quite procyclical, and banks keeping more or less the same target regarding equity adjust, and investment banks in particular produce a credit cycle that is, of course, essential to our understanding of crisis. His work on taper tantrum was also very insightful, and quite generally he has been working in regulation, and his work in regulation, I don't know any longer whether it is theoretically or empirically based or both, presumably. Now there is another nice side of our guest speaker, and that's when I first met him in Oxford a long time ago. He was in charge of port and of the portfolio, right? And so these are very particular skills that you need, especially in Oxford, especially port. Then I met him in LSE, and he was advisor to the Bank of England. Then when we met in 2009 or 2010 in Seoul, he was the advisor to the president on macroprudential regulation with some input into the G10 proposals in the Korea's presidency of the G10 meetings. And now he is an economic advisor and head of research at BIS. So somehow he combines what we share as academics with a hands-on on specific institutional and empirical facts. And so overall, I think, well, good. That's someone who considers that God is in the theory, but the devil is in the details overall, right? And so it's great to have him here and share with us these insights that come both from the academic side and from the hands-on in the institutional empirical details. Thank you, Hyun.
Thank you for that very generous introduction. It's great to be in Barcelona. I first came here when Pompeu Fabra, the economics building, was the old building before it actually moved to the new campus. Should I turn it on? I have to push. Okay, there we are. So this is somewhat of a departure from my usual topic, but I propose to tell you a little bit about global liquidity and procyclicality, because this is now, I think in terms of the current conjuncture, quite an important question. And it raises some very interesting issues, both for financial economists, but also for macroeconomists. And this has to do with the role of the dollar in the global financial system. And one way that we can motivate this question is to say, there is a conventional view of the international financial system, or the global economy, where each country or each economic area is an island in the sea, and the exchange rate is the price that determines the trade balance between islands. So this is a bit of a caricature, but I think it's not too much of a caricature. And in this sort of setting, when your currency depreciates, this is when the exchange rate becomes a force for expansion. So where depreciation is expansionary, when you have this island's view of the global economy. Another view, and this is the view that I will try to describe and argue for, is that there is a financial counterpart to this global economy as islands. And here the picture is not of islands, but rather of a very tightly set of nodes in a network. So it's like the matrix. And the nodes of the matrix turn out to be somewhat more distant to the underlying economic areas than we thought. So another way of saying that is the matrix does not respect geography. And so let me just give you one example before we move on, just to set the stage. Imagine that you are a European bank and you are intermediating dollars, you're lending to a firm in China. Okay, you're lending to a firm in China in US dollars. Now, where do you source the dollars? Well, there might be some in Hong Kong, but much more likely you would either obtain it in London, or even more likely you would get it from the branch in New York. So you go to the money market funds in the US, you borrow dollars from the money market funds, and then you source that via your headquarters in Paris to Hong Kong, and then to the firm in China. So where is the balance sheet of this bank? The assets are in Hong Kong. That's where the assets are booked. The liabilities are in New York, because that's where you have borrowed, that's where your obligations to the money market funds are. But your headquarters are in Paris. So where does this bank lie in geography? Well, it's unclear. It's partly in New York, partly in Paris, but partly in Hong Kong. But in terms of the balance sheet, it's very clear, because we have dollar assets and dollar liabilities. The fact that it's a French bank is just a detail. And that's the sense in which the matrix does not respect geography. But one thing which is constant is the US dollar. So it's the US dollar and it's a balance sheet. Now, in this setting, where you have a matrix of financial claims, a depreciation of your own currency doesn't always have an expansionary effect if you have a lot of dollar debts in your own economy. So if some of your corporates have borrowed in dollars, some of your assets may be yielding dollar cash flows, but some of them may not be. So if you're a Chinese property developer and you're sourcing dollars, then there is a currency mismatch. And so when the dollar appreciates and your currency depreciates against the dollar, that could lead to balance sheet stresses, and that could lead to contractions. Even if you have dollar cash flows, like let's say a Latin American oil firm. So if you're Pemex or if you're Petrobras, you have dollar cash flows, but we know that oil price, there's a negative correlation between the oil price and the dollar, and therefore when the dollar strengthens, the balance sheet stresses come not from a currency mismatch, but from an endogenous revaluation of the balance sheet. And I'll also show you some evidence that this is not simply a currency mismatch story, but something much broader. And the upshot is that an appreciation of your currency against the dollar is actually expansionary. But notice one very important distinction. In the conventional view, the depreciation is on a trade-weighted basis. The story that I've just told is a appreciation or depreciation vis-a-vis the dollar. And so there is a wedge which we will try and exploit later. But here is some preliminary evidence on why we should be taking more notice of these effects. So these are impulse response graphs, or cumulative impulse response graphs, from a recent paper that I did with some BIS colleagues. And it's looking at the impact of local currency appreciation against the dollar on local currency bond indicators. So the left-hand panel is showing you the impulse response to the 5-year local currency sovereign bond yield to a shock in the value of the local currency against the dollar. So when the local currency appreciates, there is a tendency for the local currency yields to fall. So financial conditions become looser. Financial conditions become more accommodative. The right-hand panel is a similar. So this is just a spread versus the U.S. Treasuries. So local currency yield in local currency compared to the equivalent U.S. Treasury yield. The right-hand panel is a similar exercise, but where we control for the difference in the interest rates between the currencies. And here, the experiment is, imagine that you're a dollar-based investor. You can invest in an emerging market sovereign bond by using the currency swap market. So you take dollars, you swap the dollars into Mexican pesos, let's say, and then you invest in the 5-year Mexican peso denominated sovereign bond. And then at the end of that period, you swap it back into dollars. So imagine that you pursue that strategy and calculate the yield to the currency swapped investment in an emerging market local currency sovereign bond, and take the spread vis-a-vis the US Treasury. And that is the exercise that Du and Schrager do in this Journal of Finance paper. And the Du-Schrager spread is the spread between the swapped investment for a dollar investor in a local currency bond versus the US Treasury yield. And again, we see this shock where the risk premium is being compressed when your local currency appreciates. So during a period when the emerging market currency is appreciating against the dollar, this is a period when the risk premium of the local currency bond market is being compressed. Now, one consequence of this is that there is an impact on the real economy. So if we do the same exercise, but now look at the impact on industrial production, we see that an appreciation is expansionary, in the sense that an appreciation shock against the US dollar imparts this upward shock to the industrial production in a group of emerging markets. So this is a panel, these are impulse responses from a panel VAR. The left-hand panel is for the bilateral exchange rate. So when the local currency appreciates against the dollar, this is expansionary. But if you do the same exercise, but for the trade-weighted exchange rate, it's actually contractionary, which is what you would normally expect in a textbook model. In a Mundell-Fleming model, it will be the right-hand panel, which would be the expected sign, because when your currency appreciates on a trade-weighted basis, this should be contractionary. But against the dollar, we have this expansionary effect. So what are we observing from this preliminary evidence? A currency appreciation against the dollar has a different effect from a purely trade-weighted exchange rate appreciation. So the two questions I'd like to address is why is it that global financial conditions are so attuned to the strength of the dollar, and why is the real economy so sensitive? And the answer turns out to be the matrix. Okay, so it's reloading the matrix, although I prefer the original, actually. The Matrix Reloaded is not a very good sequel, but this is the theme this is the theme that I like to use. How much of the dollars are we using in the global banking system? Now, in textbooks, we say the dollar is used mainly in the United States, and indeed the way that we think about international finance is to say, well, the exchange rate is just the relative price of goods, and the currency is mainly used in the borders of that country. But it turns out that the dollar is very special. If you use the BIS statistics and ask where are the cross-border dollar claims and dollar liabilities, and whose claims are they and whose liabilities are they? And we get to this kind of chart, or this pair of charts. So let me just explain and take you through these pair of charts. In both panels, the upward pointing bars are the assets, cross-border assets of the banks. Downward pointing bars are the cross-border liabilities. And we are dividing the cross-border assets and liabilities depending on where the banks are and depending on where they come from. So on the left-hand panel, we are classifying the cross-border assets and liabilities according to the location of the bank. So this is the way that we would normally do international finance. It's not really, what matters is where you are doing your business. So when we do GDP statistics, we actually look at the location rather than the nationality of the bank. On the right-hand side, on the right-hand panel, we do the same calculation, but we do it by nationality. So what that means is, if so take a concrete example. If I'm a German bank branch operating from London, on the left-hand panel, I would be classified as a UK bank. On the right-hand panel, I would be classified as a Euro area bank. So nationality and location lead to very different pictures, as you can see, and that's one thing that we can take on board immediately. So what are the colors here? The pink in the middle are the cross-border assets and the liabilities of banks in the US on the left-hand panel. On the right-hand panel, the red again is the cross-border assets and liabilities of US headquartered banks. And you see that the red shrinks as we go from the left to the right. So the US banks, so the typical household names that we talk about, have a relatively small role in cross-border intermediation of dollars. Who are the banks that have a big role? Well, on the left-hand panel, the yellow is very big. That's the UK. And the blue is the Euro area. Whereas on the right-hand panel, the blue is the Euro area, and the yellow again is the UK. And what you see is when we go from the left to the right, the blue area expands and the yellow area shrinks. That's to say, there are lots of banks in London, but many of them are Euro area banks, and the cross-border assets and liabilities in dollars of those banks that are located in London are hugely important, and many of those are from the Euro area. The UK headquartered banks, they shrink. And then the Japanese banks loom very large. That's the brown. And then the green shrinks. The green is the other non-classified. So after we have taken away the US, the UK, Japan, Euro area, and Switzerland. But European banks have played a very important role, as you see. So already we see a departure from the usual distinction we make in textbook economics. In textbook economics, we say the unit of account is the economic area, and we measure consumption, investment as part of the GDP statistics, and the GDP measurement is done for a particular economic area. Now we can measure financial flows according to GDP, which is on the left-hand panel, but we can also measure it in terms of nationality, which is the right-hand panel. Which is the right measure? Well, it really depends on the question, but for many questions, it's the right-hand panel which is the right answer. Because what you want to do is to ask, how will dollar intermediation expand or shrink depending on global conditions? Well, the actions of the branch will be determined by headquarters. And so if we want to see how the blue area shrinks, we have to look at what's happening in headquarters. So already you see a distinction there. Now, here was a pattern of how dollar intermediation did. So what I showed you before was just the totals. How do they distribute according to the different continents? Well, here's a pattern for dollar intermediation as of 2002. And you see that it's the transatlantic traffic, which was quite big. And the thickness of the lines is proportional to the amount. So the flows from the US to Europe was around $450 billion, and coming back was around 800. But notice how the lines change as we turn the clock forward, 2005, 2006, 2007, on the eve of the crisis. we've had $1 trillion increase on both legs. So we've had a flow which is larger by $1 trillion, okay, going from the US to Europe and then from Europe back. And this was very much the round tripping of US dollars that we're now familiar with. This is the business done by European banks, where they would source dollars from the US, from the money market funds. And one piece of fact which is actually very revealing is if you go to a prime money market fund, and so this was before the money market fund reform of last year, the lion's share of the assets of a money market fund would be the liabilities of banks. And around 50% would be the liabilities of European banks. So the dollars were coming to Europe, and then it was going back to the US in the form of the purchase of mortgage-backed securities. So a lot of the European businesses of dollar business was this round tripping. Now, because the funds were flowing in both directions, this wouldn't show up in the current account because the net flows would be changing only a little bit. The gross flows were much larger. But the important point is that the dollars are everywhere. It's not just in the US. In fact, if you look at the, and this is the equivalent amount in euros, which is very small, what happened after the crisis is that the link to Asia has grown tremendously. And so by 2014, the link from Asia back to the US, that was big. And the other very interesting fact is that as much dollars were being channeled to Asia via Europe as was being channeled from the US to Asia directly. So Europe plays a very important role in dollar intermediation. And that's why you saw the blue area in the earlier chart being such a large chunk. So why is the dollar so important? Now, I think one narrative goes like this. So we know that the dollar is a very important invoicing currency for trade. And Gita Gopinath at Harvard has written a lot about the invoicing role of the dollars. And this means that trade credit and financing of trade will be in dollars, but that's a very small part. A much more important part is that if you are invoicing in dollars, your cash flow is in dollars. Therefore, if you want to invest, it's very natural for you to borrow in dollars in order to invest, because the invoicing currency will give you at least some hedge. So typically, oil firms would borrow in dollars to invest, wherever they are, because oil is priced in dollars. So a lot of the oil-related debt has been issued in dollars. This means that the oil sector is one example. It's a very large sector, but this is very pervasive. So there's a lot of borrowing in dollars by real economy entities because of the invoicing. And that means that there is a lot of US dollar denominated assets globally. So if you're an asset manager, I don't know how many of you are on the buy side, but if you're an asset manager, a very large proportion of your assets will be denominated in dollars, whether you're in Europe or Japan or elsewhere. And that's because the borrowers have borrowed in dollars. And that's because the invoicing has been in dollars. So there's a chain reaction. So once the asset managers have all these assets in dollars, then there's another problem, because if you're a Japanese life insurer or a pension fund, your assets are in dollars, but your obligations are in yen. And so how do you hedge? Well, you hedge by going to a bank and saying, please, I want to sell dollars forward to you, or please enter into a swap so that I can invest in the dollar assets, but I want to hedge the currency risk. And the bank says, yes, of course, we'll do it. But then the bank has to lay off that risk. So if the bank takes on dollar assets, it has to borrow dollars in order to balance out the currency risk. So that if you have dollar risk if you have a long position in dollars, then you have to match it with a short position in dollars. So there's a huge banking sector dollar liability part, which is due to the hedging needs of long-term investors. So you see this chain where the invoicing, which seems like a very innocuous feature, has led to a long chain of different effects where in the end the banks have to borrow dollars in huge amounts. And this is just one example. You can think of investment, you can think of other real economy parts, as well as speculative uses as well. Now, what this means is that because there's so much dollar debt outside the United States, one of the features that looms very large is the fact that when the dollar appreciates, cross-border lending and borrowing in dollars shrinks. So the dollar becomes very much a risk factor that determines leverage. So in the domestic context, we know that variables like the VIX used to work quite well. The VIX is now broken down for many reasons which we cannot go into today. But before the crisis, the VIX used to work very well as a regulator of leverage. Nowadays, it's the dollar. So when the dollar becomes strong, that's when leverage comes down. When the dollar is weak, that's when leverage expands. And here's some evidence. So this is just from the BIS banking statistics, looking at the increase in the cross-border lending in dollars as a function of the broad dollar index, how much that has changed. And this is just a contemporaneous scatter plot. On the right-hand side, we just run a moving average 20-quarter moving average regression. And the red dots give you the sign, give you the magnitude of the coefficient of that regression. And you see that the sign goes negative, especially during the crisis, and has stayed negative thereafter. So that's to say, when the dollar strengthens, cross-border lending shrinks. And it's a reflection of the leverage decisions. What's interesting is that the euro has also begun to take on a similar feature. So on the left-hand side, there are two scatters. The red dots refer to an earlier period. The blue dots refer to the post-crisis period. And you see that the negative slope has only come fairly recently. And you see it also on the right-hand panel, where the coefficients have become negative only fairly recently after the crisis. Now, for emerging markets, this will have some effect. And so let's look at some indicators. So here's one indicator of the CDS spreads for a number of emerging markets. And what I've done here is to just collect the CDS sovereign spreads of a number of emerging markets. On the vertical axis, I'm going to show you the deviation of it's the increase in the CDS relative to the end of 2012. On the horizontal axis, it's how much the local currency has depreciated against the dollar. So if you move to the left-hand side, it means that your currency has depreciated more and more against the dollar. And the bubbles refer to the size of the US dollar denominated debt in that country. Okay? And so this is for a number of emerging markets. And this is a picture as of the end of end of September 2013. And if we turn the clock forward, we see that in 2014 the dollar has strengthened, and so all the bubbles move to the left. But notice that some of them are moving up as well. And then as the dollar strengthens, we see Russia, we see Turkey, these bubbles going up to the left-hand corner. And notice two things. There is both a time series element and the cross-section element. So in the time series, what we see is that as the dollar strengthens, the CDS spreads go up. In the cross-section, at any moment in time, those currencies that have depreciated most against the dollar are the ones whose CDS has gone up most. And as the dollar weakens, we then come back. So what this means is that from a methodological point of view, we have to reorient ourselves in how we think about the global economy. So here's a textbook picture of how we teach international finance, where we say, well, here there's one economic area, there's another economic area, and then we measure GDP within the boundaries, and the exchange rate is just a relative price of goods between these economic areas. And the balance sheet just lies in the economic area, and then the current account is just the borrowing need of one country versus another, and the exchange rate is going to adjust if you let it float in order to restore balance. And monetary policy is purely about what happens within that economic area because the currency is only used within the dotted lines. Now we've seen that this is not going to be a very useful picture. In fact, this is probably the better picture, where we say, the mapping is not at all easy because, if you think about that European bank that is lending dollars in China by sourcing dollars in New York, that mapping between the balance sheet and geography is not a very good one, but we can still map the balance sheets. So there are global banks in the middle. So how that global bank maps into a geographical area is going to be very complicated. It's not going to be very easy, but if we do it in terms of the units of the balance sheet, we can say there is a group of global banks. They draw on the wholesale money market, the wholesale funding market in dollars. And then they would lend dollars to local banks. And local banks could either be the locally incorporated banks that are owned locally in the emerging market, or they could be the branches or the subsidiaries, the affiliates of global banks operating in those countries. But they're the ones who receive dollar funding and then pass on the dollar funding to the borrowers in each region. Now, what this means is that because of this mapping between geography and balance sheets being very complicated, this poses a really big set of questions for us if we want to incorporate these types of effects in conventional macroeconomic models. Because conventionally, when we do macro, let me just skip this because of time. If you're coming to the seminar tomorrow at the department, I will go through this set of slides. If you open up a textbook in international macro, of course, we're interested in general equilibrium models, and general equilibrium means we're interested in GDP components, consumption, investment, net exports. But what is the unit of measurement when we measure consumption? Well, first of all, we have to have a well-defined GDP area, because GDP has to be measured within a region. And the question is, how do we map consumption with a balance sheet? Okay, so you remember the French bank, which was borrowing dollars in New York and lending in China. Well, it's good, that bank's activities will affect consumption in some countries in Asia, but what is the mapping between consumption, let's say, in China and the balance sheet of this French bank? It's not at all obvious how we can do that. Now, there are two ways to go. One is to go and drill down to the firm level. So if we drill down to the firm level data, this is the trend. I think this is now very much the trend in empirical work, and not just in international finance, but in many areas. And Jose Luis has done a very exemplary work on using the credit registry data to map out the individual relationships. So that's one way to go, where we know that the balance sheet makes sense if you drill down to the actual balance sheet. But that's not really the way that macroeconomists operate, because macro is about macro. It's not about the micro. So what is the other alternative? The other alternative is actually to drill up. Because we know that even though we have two different partitions of the world, so there are two different partitions, there are different ways of dividing up the world. But we know that if we add up everything, we always reach the same set, right? It's a universal set. At the bottom, we have the null set. We can order these sets. We have two different partitions that are difficult to order, and they're non-overlapping. So you can either go right to the micro, but you can also go to the macro. And that's to say, you can go to the global level. So if you're operating at the global level and operating with global aggregates, then that's another way of capturing these macro effects. And the BIS has pioneered this. What we've done is to publish the BIS global liquidity statistics, the global liquidity indicators, where we add up a lot of these aggregates and then report them at the global level. And it turns out that empirically, this global aggregate has a very important role to play in explaining the GDP components in all the regions as well. This is why when I showed you these impulse response functions, it's very clear that there is a global factor, and the global factor seems to be something to do with the dollar. But it does pose some great challenges for the way that we try to model this, because theoretically, we instinctively go for consumption, investment, and GDP components. Now, we can do that with this different classification at the same time, but to combine them is going to be a very difficult theoretical challenge. But what I and some co-authors have done is to write down a different model where the unit of account is not the GDP area, but the balance sheet. So it's really the model that corresponds to this picture. So if you just write down the model in terms of the balance sheet, where irrespective of where the border is, because the border is going to be crisscrossing here, the mapping is not going to be so clear, but we know how banks behave. So irrespective of where the balance sheets are geographically, we can model the balance sheet. And because the currency is common throughout, okay, so a dollar is the same whether it's in Europe or whether it's in Asia. And that's going to be a hugely simplifying factor for us to write the model. And then once we do that, then we can write a global model. So let me just leave you with one motto, which is, if you want to get to the bottom of global liquidity, you have to have a global analysis rather than an international analysis. International means you're using the island's view of the world. So it's the international. And that's not enough. You have to use a global model because the international model doesn't map very well to the balance sheet dimension. So let me just stop there. I think we managed a good time, but I'd be happy to take some questions.
Well, it's Q&A time now. We have our assistants here that will give you the microphone if you ask for it. Anyway, just to open the question session, you've told us, Dr. Shin, about the role of the dollar. What about the global reserve currency function of the dollar? Is the dollar going to remain central? In your opinion, is there any challenger to the dollar? And which would be the challenger?
Well, the correct answer used to be the euro. But I think to be serious for a second, I think the first question is when would the dollar lose its status as an international reserve currency? I think the answer is probably not. In some ways, even though the U.S. is becoming smaller, relatively speaking, in terms of its economic weight, the dollar has maintained its role, its global role, and you saw that in the aggregates. And I think what that means is, both from the point of view of the precautionary motive, and also from the point of view of leaning against the wind, against currency appreciation, in conducting your monetary policy, it would be very natural for the central bank to be accumulating dollar assets rather than any other. But one of the charts that I showed you earlier is that the euro itself has become has taken on the character of a global funding currency as well. You saw that in the euro. Let's see if I could just have that slide. Can I have the slide back? It's, well, if you remember the slide, we had the downward sloping relationship between the appreciation of the euro and the contraction in the cross-border funding in euros, and that is again very indicative of the fact that the euro was being used in many of the international functions as well. So look at the blue charts. Look at the blue dots here. You see this very telltale negative slope. So the euro has become much more of an international funding currency, and I think partly that is due to the fact that monetary policy has been quite accommodative in the euro area, so that just as dollar cross-border flows became very important when US monetary policy was very accommodative. I think there is a similar effect here, but for the euro as well. But the domain of the euro is not as global as the dollar. I think it's the Central European region and the broader the broader European region. So it's the UK. The non-euro area European countries that have been much more taking part in this kind of activity. But the euro certainly has played a much more important role as well, and to that extent, I think its role as a reserve currency, if anything, has become more important.
Thank you.
I was wondering what happened. Two questions. I was wondering what happened in this figure, in the figure for the dollar, if you also do this time change between pre and post crisis. So you see exactly the same. It's exactly the same thing. And the second is, how is this view that you have to go global instead of international, how that affects the way in which you have to think about monetary policy in the context of particular countries or areas?
Yes. I think this is a very good question, and it does raise some issues about many of the, I think, rules of thumb that we use. We know that in the standard monetary economics model, if the exchange rate is well behaved, then we can use pretty much the same types of models as we do for the closed economy, except that we have to think about the pass-through and just modify the rule for the international dimension. But if you look at this kind of chart, it means what this shows you is that in order for you to have some influence on your domestic currency yield curve, you have to take account of the exchange rate as well. So to some extent, monetary conditions domestically is not fully determined by your own monetary policy, or rather, your monetary policy has to be defined in a broader context, which takes account of the effect on exchange rates as well. And so a typical dilemma that an emerging market monetary policy maker would face would be a period when there are rapid capital inflows domestic currency is appreciating very strongly, but as these charts show, risk premiums are also very low. So it's basically a boom scenario. Now, what do? Do you tighten monetary policy or do you loosen monetary policy? Empirically, it seems that most open economies have tended to follow the advanced economy monetary rules down. So when advanced economies have kept rates low, they have gradually lowered their policy rates as well. And why would they do that when, when domestic conditions are already very ample, already very accommodative? Well, the answer is if you then break out of the pack and raise rates when everyone else's rates are very low, this could simply amplify the capital inflow pressure and exacerbate the exchange rate appreciation and have further accommodative conditions like this. So when you raise rates, paradoxically, it's certainly beyond the realms of possibility that you will end up with a lower long-term rate if this kind of effect is very strong. So it's a bit of a dilemma. Do you raise rates or do you lower rates? And to some extent, this is why many emerging markets and some advanced economies have used a second strategy to their monetary policy, which is the exchange rate, which is look at the exchange rate as well as the monetary policy rule. And some central banks have explicitly said that they intervene in the currency market in order to lean against the currency appreciation. And also empirically, emerging markets are, although they are reluctant to own up to it explicitly, many emerging markets also lean against the wind as a second string to the bow. So I think the short answer to, after this very long introduction, is that the exchange rate is another dimension of monetary policy, and it cannot be neglected. So there is a normal domestic monetary policy, but then you have to do something on the exchange rate as well. Now, there's a very interesting set of empirical results that come from researchers from the IMF. It's Jonathan Ostry and his colleagues at the research department, where they show that if you look at the change in the FX reserves as a function of GDP, that tends to have when foreign exchange reserves as a function of as a fraction of GDP goes up, then this has an effect of reducing credit growth. Now, one way to interpret that is, one reason for FX reserves to be going up is that central bank is intervening. So it's intervening, buying up dollars, and is sterilizing by putting other domestic government bonds into the market. So the combined effect of that is going to be to lean against currency appreciation and also it's a kind of reverse QE. You're actually injecting more government bonds into the market. So it's the QE but in reverse. And the effect will be your currency will appreciate less and your domestic interest rates are going to be coming down less. So it's a kind of a tool that will address both the currency appreciation and the compression and the yield premium as well. So that would be one way you can understand that. But that may be one empirical fact which reinforces the idea that the exchange rate may be a very important element in monetary policy.
Another way would be, for instance, Brazil intervened after the taper tantrum. They intervened in the FX market. But at the same time, they had capital controls and macroprudential policies. So two other choices are capital controls and macroprudential policies. What is your opinion on that? And then the second question is it the US exchange rate or the US monetary policy which is driving the global financial cycle?
On the first, I think this the debate about capital controls versus macroprudential instruments is, of course, a very important one. And at some level, that distinction becomes somewhat beside the point, because if you have this picture of the matrix and you're reloading the matrix, then the border doesn't really matter. It's really the balance sheet. Now, it's true that the levers of control are often at the border from a purely administrative perspective. So maybe practically speaking, capital controls may still retain some importance. But the perspective, I think, is that it's more a cross-currency phenomenon rather than a cross-border phenomenon. And once you make that distinction, the difference between prudential policy that leans against the excess leverage of the banking sector versus capital controls becomes much more blurred. So the sharp distinction we often draw between financial regulation and capital controls seems much less justified. And indeed, there's I think a good argument for saying that if you looked at the situation before, one way that you could have addressed the building vulnerabilities before the crisis was to address the banking sector, even before these balance sheets became very strong, became very big. Now, it's true that that may be another way that you could retain some autonomy. The problem is that it's a very leaky bucket. So it may be that a leaky bucket is better than no bucket, but it may be a very leaky bucket. And so that's, I think, the big dilemma. And the other dilemma is a political one, because capital controls carry a lot of stigma, and within the European Union, of course, that would be illegal. That is against the Maastricht Treaty, and so this is another reason why capital controls would not be a very easy tool. As for whether, so you ask whether it's the exchange rate or monetary policy. Well, of course, the answer is they're very closely related. The dollar, we know that even from the 1990s, we have a long set of papers that. So this is the Eichenbaum and Evans paper from '95, which is the classic reference, which already shows that a tightening of monetary policy in the U.S. leads to a delayed appreciation of the dollar. And it's very much in tune with this kind of effect. And in some work that I've done with Valentina Bruno, what we show is that, in fact, it's the leverage. It's the banking sector leverage which is the driving force that explains that link, which is very much in tune with this story. And that, of course, is a function of monetary policy. So global, not international.
Actually, it's great that you mentioned this global versus international, because my question was, it's related actually to capital controls, and some have argued that the Fed should basically indefinitely extend these FX swap lines that they have with these other central banks. Is this an example of thinking global instead of international, or what's your feeling on this type of policies? I mean, some people have argued that they would generate moral hazard problems and whatnot, so it's also a contentious issue.
So tomorrow at the seminar in the department, I will go into this in more detail. One of the financial anomalies we see is the deviation from covered interest parity. The cross-currency basis has become a very important part of the currency market now, and some have argued, well, you can close that if the supply of dollars is much larger. But I think the point is that the swap lines were envisaged much more as a liquidity provision tool when there are financial stability dangers, rather than simply a way to allow arbitrageurs to make even more profit. And so I think to the extent that the dollar is everywhere, then I think these liquidity tools, these liquidity, emergency liquidity provision tools, will have a very important role to play. But there's an issue about to what use one should put these swap lines. Is it there just to close up any gap, or should we leave it, or should we leave the powder dry for a real emergency? And then, but there are broader issues that have to do with the, of course, the international political economy. Yeah? And we can go into that more in tomorrow's seminar.
Well, it's 8 o'clock. It's 8 o'clock. It's perhaps the time to close the event. Dr. Shin, Professor Freshers, faculty and students of the Barcelona GSE, members of the Banc Sabadell teams. I would now just like to thank you for your attendance and attention and invite you to join us at the foyer just next door, where we will be holding a small cover reception, which is a courtesy by Banco Sabadell, and we'll give you the time to share thoughts, taking the opportunity of the relaxed atmosphere we expect to create there. So please follow us to the foyer.